All right, welcome back to another episode of Forward Guidance. And joining me today is repeat guest Michael Howell of Cross Border Capital, the man with the knowledge of liquidity. Michael, great to have you back on the show. How's things?
Well, hi Felix. Pretty good, thanks. Yeah, but a lot of things going on in markets right now, so I'm sure there's lots to talk about.
Yeah, a lot of cross currents for sure. Super excited to catch up with you. There's a lot of moving parts, especially within the bank reserve system and liquidity as a whole. And I want to deep dive into that. And so I'm actually going to take the liberty in this episode of assuming that my audience, which I know they have been regular listeners to yourself. So we're going to assume some knowledge there and do a bit of a deep dive in this episode and get into some pretty unique topics. And the first topic that I want to get into today is really around understanding the banking reserve situation at hand and where are we at within it. So oftentimes when central bankers talk about bank reserves in the system, they use this idea of, are we in an ample regime or a scarce regime or an abundant regime? We've been in a highly ample regime for the last couple of years, ever since COVID. And as they've been going forth with QT, et cetera, we're getting closer and closer to, this point where I wouldn't say we're at scarce yet, maybe abundant, maybe ample, but would just love to hear of, where do we sit within this situation of bank reserves as they stand?
Well, I think we can actually go into detail of where we think the limits are, and we think we're actually very close. And I've gone on record to say that if you extrapolate what's happening at the Federal Reserve, it's quite likely that to put it bluntly, the money runs out probably this September. So we're very close to that threshold, that dangerous threshold. And if you look at repo markets, I mean, repo markets are starting to see, widening spreads. I mean, that's for sure, consistently widening spreads. And that must be troublesome for Federal Reserve policymakers. I mean, they've got to be aware of this. They say they don't want a repeat of the 2019 repo crisis, but, we're sort of edging near all the time. But what I would say is it's, certainly part of the story is bank reserve. The financial system has come a long way in the last decade or decade and a half. And we've got to start looking very closely at collateral as well. And it's the repo market which really brings together, if you like, liquidity and collateral in one place. And so looking at repo rates is clearly important. But you've also got to understand the whole collateral background and maybe the whole structure or shape of the financial system, and maybe why it's looking dangerous or maybe vulnerable at the moment, particularly in the context of a potentially slowing US economy. And these are all topics we can address. If the US economy slows down from, let's say, circa, 7% NGDP growth to something under 4%, that's going to be, a heavy weight for credit markets really to bear. And, I don't really, envy the prospects of them, actually.
Yeah, totally. Okay, so Michael, maybe what we can do here just to get everybody up to speed is if you could just get us up to speed on what you've called this pump and dump that we've gone through the last couple of years of these more unique levers that they've been pulling to make sure that we can float through this phase towards managing liquidity as a whole. To your point, it's not just about bank reserves. There's also a lot more dynamics about it. So, okay, we're getting to this point where we had almost too many reserves in 2021. But then we got to this point where they started to do QT, but they wanted to do QT without it really affecting the markets too much for a whole host of different reasons that we can get into. But what was that process look like, and where does that lead us today? And I know you have a few charts that we could look at as well as we go through.
Okay, well, let me first start on what you've described as the pump and dump, which I think is a big deal. And I think it's not properly focused on. It's been aired by the administration as something that they've been concerned about. And this was really activities that Powell and Yellen got up to in 2024, arguably, or allegedly, to try and get Biden reelected. I mean, clearly that failed. But there was a secret or hidden stimulus that went through the US economy. Now, I'll talk about that. Then I'll go on to say something about the structure of the financial system, why this matters, drill into bank reserves, and then come back to this collateral question, which is another thing to do. Let me just describe what's going on here, because it's maybe it's not apparent at first sight what it means or what it really conveys. What this chart is looking at is, in orange, there is a region measured in trillions of dollars of what we call not QE. And that is the activities of the Federal Reserve outside of their stated QT or balance sheet policy. And what I mean by that, by balance sheet policy, is basically letting treasuries roll off the balance sheet. That's how the current FOMC defines QT. Arguably, one would say that by parallel, if they were accumulating treasuries, that would be under their remit QE. It was not how QE was originally envisioned. If you go way back to Ben Bernanke, who said it was all about looking at the reaction of bank reserves, and he's very clear. Made a very clear statement about that. So the goalposts have changed in what the Federal Reserve is talking about, but let's get a consistent and clear definition. And the orange area in that chart is what I've called not QE, which is activities outside of treasuries or MBS securities. This is things like the reverse repo facility, the rundown in reverse repos, its fluctuations in the Treasury General Account, its operating losses that the Federal Reserve makes on its holdings, and it's things like, which are now defunct, the Bank Term Funding Program. So all those factors are part of that orange area. So this was liquidity injections that the Federal Reserve was undertaking into the system outside of their stated QT policy. So in other words, they weren't really doing QT, they were doing a hidden QE, hence the name. On top of that, the Treasury, very cleverly perhaps, via Janet Yellen, decided what they were going to do was to start to fund the US government through very short-dated tenors and bills. So something like over 60% of funding of the US deficit since the end of 2023, if my memory serves me correctly, 60% was in the form of bills. So these are astronomically high numbers from in recent history. Bills are very short-dated government securities. They don't pay a coupon. They have a maturity up to 12 months. They're loved by banks and credit providers, but if banks and credit providers buy these things, that's pure monetization of the deficit. And that really is what's been going on. Now, the red area there is to show the effect of that stimulus on the economy. So if you add together what the Treasury was doing through this change in the funding dynamics, the change in the tenor of funding, and you add to that what the Federal Reserve was up to in terms of its not QE, the YCC there is it denotes yield curve control. So this was a subtle way of operating yield curve control. What you can see at the peak in early 2024, that was about $6 trillion. So it was a huge shot in the arm for both markets and the economy. This was extra liquidity that was flowing into the system effectively. Now, what you can see over the course of 2024 is that has tailed off pretty sharply. So we're now down to under $1 trillion of that stimulus. And it's that second derivative which is really important in terms of understanding the impact both on markets and increasingly on the economy. Now, if I show you the next chart, which is looking at that same data, but here what I've done is to show it alongside the Philly Fed manufacturing survey in black to try and show that this is actually having an effect on the economy. And what I've done here is to advance that hidden stimulus forward by 9 months. So this may not be recessionary yet, but it's certainly causing a sharp slowdown in the economy. And that's something I think we need to understand. And if you start to think about what that might mean, what this is showing is an AI-based analysis of world GDP growth. So this is a daily measure that we put together. It comes from putting lots of different data sets into the hopper and optimizing through an algorithm. But it's things like currencies of trade-sensitive economies. It's things like credit spreads. It's things like commodity prices, etc. And what it's trying to show is how the world economy has slowed down very markedly since the middle of December. Now, this was really before the tariff hiatus or the debate about tariffs really got off the ground. And it would suggest that there was already a slowdown underway in terms of world economic growth prior to that date. And I would venture that a large part of that was this decline in this hidden stimulus. So this is why we're starting to see evidence of a slower economy. And, the tariff, uncertainty is only going to add to that. So what we call is a threat to credit markets potentially coming up. Why is that important? We can go into that.
Yeah, so I do want to get into the implications of what needs to happen next in a second, but I do want to clarify a few things before we get into that. So if you go back to that first chart that you just mentioned there, when you use these definitions of not QE, not yield curve control, um, what I assume is these are shorthand definitions to say effectively we have fiscal and monetary duration management. You're not necessarily saying this is, large scale asset purchases. We had a few weeks ago Powell's on testimony at the Senate where you mentioned, we won't see QE until rates are at zero at the very least. And I think that confused a lot of people because there's also this discussion of, QE needs to happen soon. You've mentioned a few things happening. So I just want to really clarify, when you're saying that as we get forward into the conversation here, that some version of duration management needs to occur. Are you saying outright quantitative easing, where the Federal Reserve is buying bonds from the secondary market and swapping them for central bank reserves, or is this something more along the lines of a BTFP type facility that allows them to manage the duration, but it's still a loan facility? So just want to clarify, what exactly do we mean here when we talk about these definitions?
Let's be clear. What I'm saying is that what we need is more liquidity into the system. And that basically means an expanding. I mean, our definition of liquidity is essentially the balance sheet capacity of the financial system. Okay, that's a crude, a very wide, broad, but a basic definition. And the reason that's important is that we live in a debt-driven world. Debt dominates everything we do. There is huge amounts of debt that need to be refinanced every year. Okay, capital markets today are not about new capital raising for investment projects. They're all about rolling over existing debt. And if you're going to roll over existing debt, what you need is balance sheet capacity. And that balance sheet capacity is determined by as I say, the financial sector. But the financial sector, its growth or its expansion is governed by what central banks and regulators are basically determining, or what they're suggesting. If the central bank itself is shrinking its balance sheet, it's extremely difficult for the financial sector to expand its. So the Federal Reserve needs to step in and expand its balance sheet. And one of the things that you can see, and I can demonstrate this with a chart quite easily, is that if you look at the long-term history of financial markets, what this is showing is this is the ratio between advanced economies' debt relative to global liquidity, or the advanced economies' liquidity. Now, this is a much, much more meaningful statistic than what I would say is the spurious figure that's often thrown out, which is debt to GDP. Now, debt to GDP is probably looked at because it's convenient and easy to measure. But like many things in economics, those things which are easy to measure take on inflated importance, when in actual fact they're irrelevant. And debt to GDP doesn't really mean very much in my sense. What you need to look at is whether that debt can be refinanced. And therefore, what you need to look at is the debt to liquidity ratio in the economy. Now, what this ratio shows here is the history for the advanced economies of debt to liquidity. And what you can see from the dotted line that we've drawn on that, it is an equilibrating or mean reverting relationship. And if you try and test this statistically, it comes out unambiguously, this is a mean reverting data series. And it mean reverts at roughly speaking 2 to 1. So, twice as much debt per dollar of liquidity. If you have too much debt relative to liquidity, and I've annotated the chart correspondingly, you tend to find at the upper reaches of that chart financial crises. I would venture that every financial crisis in the last 30 years or so, 40 years, has been a debt refinancing crisis in some shape or form. When you get the reverse, when the debt to liquidity ratio is very low, in other words, when there is abundant liquidity in the system, you get asset bubbles. Now, let's look at where we're starting from now. We're starting from a period where we've seen, something like 10 years at least of a very depressed debt to liquidity ratios. Now, why is that? Number one reason is that central banks threw an awful lot of liquidity back into the system in the wake of the 2008 GFC, understandably, because the financial system was struggling at that point with their balance sheet. And then they added more during the period of the COVID emergency. As we know, that was an abundant liquidity injection, and it forced the debt GDP ratio lower. On top of that, zero interest rates, as were enacted through much of that period, incentivized many corporations and even governments to start to term out their debt. So what they did is they basically borrowed at low interest rates, and that terming out of debt, the so-called debt maturity wall, is coming back to haunt investors over the next 2 to 3 years. And that's why if you look at that chart, you will see that the orange line in the projection period is starting to go almost near vertical. And that's because a lot of that termed out debt is coming back. Now, this is enough to end the bull market by definition. It may not be enough yet to cause a bear market, but clearly one's eyes have got to be very closely on the ball here, because one slip could be a serious issue. And central banks need to be alert to these balance sheet questions. And as I keep stressing, we're in a debt refinancing world where balance sheet matters. We're no longer in a capital spending world where interest rates and the cost of capital are paramount. It's not about interest rates, it's about balance sheet. And I wish policymakers would start to realize that.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Yeah. Michael, something that really piqued my interest that you wrote about last week, and which is why I fervently rushed out to get you on the show here, is mechanically and quantifiably understanding this idea of a balance sheet expansion that needs further assistance from monetary policy, i.e. some form of QE or something like that. So let's just unpack this here a little bit. So in your report that you wrote last week, you'd mentioned this idea that there's this static balance sheet growth in a way. So if we just quantify it by say, okay, if nominal GDP is running at 5%, I think is what you had in there, but debt is growing at 7 or 8% every year. Can you just explain this idea that, we've seen a few charts. We've seen projections from, the CBO and even like monetary policy makers where they anticipate bank reserves to increase in the coming years. And I think that causes a lot of confusion because they assume, the Fed is saying that they expect to do QE in a couple of years, and we can get into the semantics of it. But my understanding of that is related to this static balance sheet growth that you mentioned in terms of it tracking the growth of nominal GDP, primarily through the growth of interest on reserve balances, because the Fed is paying that out every day. So if you assume that covers that 5%, but what you're saying is debt is growing by 7 or 8% a year, is the spread between those two numbers what you're saying needs to be covered by the Fed, i.e. through something like QE or a different loan facility? I would love to get into the specific semantics of what you think is required there. And why is it that the private sector can't be the ones to relever and cover that? Why does it have to be from this outside government source?
Okay, well, let me go down this road. Mm-hmm. So the first thing to say is, what is the likely growth of debt over the medium term? And let's just take the government as a lead here. And let's assume that you've got an interest bill of circa 4%. Now, we know interest rates are higher than that, but actually a lot of government debt is embedded at lower interest rates. So the average interest bill is sort of converging towards a figure of about 4 to 4.5%, given current interest rates. So let's take a figure of 4%, which is practical. On top of that, you've got a deficit. Now, the deficit's clearly been 7 to 8% in the last 2 or 3 years. But let's assume that comes down. That may be a heroic assumption, but let's assume that comes down to about 4%. And that's even disregarding recessions. And we know in recessions in the past, the US fiscal deficit has just blown out enormously. But let's put that to one side. So let's assume it's 4 plus 4, which is 8%. So what you've got is debt compounding at 8%. If you take my rationale that liquidity has to match the pace or match debt, so liquidity growth and debt have to grow pretty much together, you're talking about 8% growth for liquidity. Now, that's liquidity for the entire system. And then you would expect if regulators and central banks are controlling the system, then we've got to have uh, the ability for the central bank balance sheet to expand pari passu with that expanding global liquidity picture, or US liquidity picture. The Fed has got to keep pace with that in a steady state. So you would expect that the Fed balance sheet should be growing at about 8% per annum, or that sort of figure. Now, the fact is that it's not at the moment. And what's happening is that bank reserves are kind of stuck at low levels. And I think that's where you start to get a problem. Now, we can fix on that in two ways. One is I can show you a chart which describes the structure of the world monetary system, which I'll try and do here. And this may be a little bit complicated, but let me just try and run through some of the basics. Now, this is my interpretation of how the world financial system works post-GFC. And what you've got there is a pool of global liquidity at the bottom. And that pool of global liquidity really depends on collateral. Now, where collateral and global liquidity meet, the sort of nexus or the sort of choke point is the repo market, which I put there in the center. Collateral essentially comes in two forms. One is public debt instruments, which is really the area, let's say, of thinking about traditional banks, which hold a lot of that stuff. And then you've got shadow banks on the right-hand side, on the that upper circle, who tend to use not only public debt, but they also use private debt instruments such as collateralized loan obligations, for example, as well. Now, one of the things that's happening is you're getting this shift from the left-hand side to the right-hand side because of regulatory arbitrage. And what that really means is that the regulators have got their paws on the banks, or their hands around the banks' throats so severely that effectively the system, the credit system, is migrating from the left-hand side to the right-hand side. There's more and more shadow banking activity going on.
Is that because of things like the SLR ratio that are allowing?
All these sorts of things are basically making it very difficult or unprofitable for the banks to basically operate through their own balance sheets. So these things are effectively migrating to other credit providers, or they're basically migrating off balance sheet of the banks. Now, what I've tried to say on that diagram, and you can look at it in more detail later, but effectively what you've got are two means of control in the system. One is you've got lender of the last resort, which is basically traditional central banking, which is providing reserves for the banks, and that goes up the sort of the left-hand channel. That area has traditionally been, because it's been about looking at investing in safe assets, that's sort of been deviation suppressing. So in other words, the cycle tends to be attenuated by those activities. Then if you look at the right-hand side, what you've got is kind of a new function in a way. You might say this is the central banks, or the central bank stroke treasury, trying to act as dealer of the last resort and trying to preserve or maintain collateral values. And collateral values are clearly important. Now, the difficulty that the authorities have is that the more you shift from left to right, and the more that the system tends to leverage up or uses collateral private debt instruments, the more that they're really outside the scope of the normal safety net. And what you can find is that that becomes a deviation amplifying, in other words, very pro-cyclical process. And that's the danger we get into. So what we've got to start to think about is, what is the integrity of that private sector collateral? Because that is not wholly backstopped by the authorities. And that's the danger. Therefore, if you get a slowing economy, you can actually get a negative feedback coming through into the financial system, which causes potentially a cascade downwards. And that's the threat. That's what we saw in 2008. I'm not saying we're going to get a 2008 now, because everyone's a lot smarter. But we've got to be alert to these risks. And if you start to look at these problems, to look at the threats that are being posed, this is what's happening in terms of the repo markets. Now, this is looking at one of the ways to judge tensions in the repo market. It's one of several indicators one can look at, but this is a pretty direct one. This is looking at the difference between SOFR rates, which is basically the key repo rate in the system, minus Fed funds, the Fed funds target. And what I've put on that is two tram lines. Those two tram lines are indicating where you would expect the normal spread to be. And this is what's happened. If you can make out where 2024 and 2025 are, they're basically on the right-hand side of that page. Now, what that's saying is there's a tremendous amount of bunching, particularly in the last 6 months, which is showing SOFR rates exceeding Fed funds. And that is suggesting that what you've got is problems in the repo market. It's either a shortage of high quality collateral or a simple lack of liquidity. But the market's starting to break down. And this is the heartbeat of the system. So this
Yeah.
is why it's kind of dangerous right now.
Yeah, I'm glad you brought this up because I did want to follow up to your point. There's a lot of different ways to measure bank reserve stress, and this is one of them. And to my understanding, most of those big spikes upward are around end of quarter when those dynamics get strained. And something I want to bring up is just to understand this timeline of when this stress is going to occur. Because to your point, yes, the first time that this will start to show up in terms of strains will be at these end of quarters. We've seen a couple times where the Fed has come in and tried to lift up their standing repo facility that they have there, but tried to allow that to make sure that these bands stay within check. But so far we haven't actually seen that much uptake in the standing repo facility, in the discount window. So I just want to understand the timeline, because obviously you're correct that this is where it's going to start, is these end of quarters. But we're not at the point where they have to go to the discount window or to the standing repo facility every day to get reserves. So are you just saying that we're seeing the beginnings and this is going to accelerate into the fall?
Well, what I would say, Felix, is that this is not where it starts. This is where it ends. Okay.
Okay.
This is where you start to see it. The trouble is with this indicator is it's not necessarily a pressing indicator unless you look at the trend in it. What I'm saying is it's kind of worrying to me that you've got this bunching going on in terms of potential stress or tensions in this market. Now, if you look at this chart, which is probably the more meaningful one to look at, and let me just try and articulate what goes on here. So basically what I've got is there are three lines on this chart, and there's a little window that I'm going to explain in a moment. The orange line is US banks reserves. Now, US banks reserves effectively is a pretty good way to measure money market liquidity, cash in the money markets, I should be saying. So it's pretty much equivalent. And what this is basically telling us is that what you've seen over much of that period, certainly since the middle of the graph, is a flatlining of bank reserves. Arguably, you could say they've trended upwards, and at different times they clearly jumped. And you can see one specific jump, which is the SVB crisis, where there was a clear increase in Fed liquidity and consequently bank reserves. The line that's below that, the darker red line, is a one standard deviation displacement below that line to try and capture the tail of the distribution of bank reserves between the major banks and the smaller regional banks. And this is an inexact way of measuring it, but it's really one way of trying to understand where you may be getting problems. And that's why we've drawn it.
Yeah, I think it's really important to show that too, because bank reserves are very uneven between the large JP Morgans and the small commercial banks. So I think that's really great to have that lower bound for that.
Exactly. Now, what I've then done is to try and estimate what is the average, adequate reserve level in the system, or minimum reserve level, by that dotted bright red line. And that is estimated from the little regression chart that you can see there. And that regression chart basically looks over time at how bank reserves have evolved, or the target level of minimum bank reserves. The first 5 or 6 observations are directly taken from the Federal Reserve, and the latest observation is one that we estimated, looking at where you start to get repo market tensions. So that's really what's gone into those estimates. And what I've done is I've drawn that adequate or minimum reserve level tangential to the lower bound, or the one standard deviation displacement, to try and indicate where you may get tensions. And there was a step down in that level in August of last year when the rules changed for bank stress tests. Clearly, there could be a step down again if they change the supplementary liquidity ratio. That's another possibility. But these are one-off changes. And what this is basically telling us is that if you project bank reserves forward through the end of this year, taking into account things like the debt ceiling, taking into account the rundown and then subsequent building up of the Treasury General account, assume that we've got a little bit more to run off in the reverse repo facility. We know that the bank term funding program has ended. etc. You've got operating losses continuing. But you add all those things in and you add seasonality in the TGA, what you find is that you get the picture that we depict there. Now, the dip down that you can see is basically to do with the April tax bill season. That pushes reserves down because it takes money out of money markets. Then there's an increase in bank reserves because the TGA is run down further, assuming the debt ceiling is not resolved quickly. And then in the second half of the year, what I've assumed is you get a rebuild of the TGA, and I've added in there as well seasonal effects in the TGA. And basically what you get is that profile. So it looks to us that sometime around September of this year, you get a problem. Bank reserves get below that threshold. So what you would assume is that repo market tensions start to build. So these are things that we look at because we're looking at quantity fundamentally. In other words, the quantity of liquidity in the system. We're not looking at interest rates or trying to predict rates in that regard.
Sure.
This is the main focus.
Okay, that is a really excellent characterization of the situation at hand. I think it's really important to show that, yeah, what you have on here is the TJ drawdown that we're seeing right now, and then the ensuing rebuild, which is obviously something that the Fed is concerned about right now. That's why they paused or hinted at pausing QT. They haven't fully paused it. They're still running down MBS and I think 5 billion of treasuries, but it's top of their mind. So, okay, everything we've talked about, which is that the levers that have been used for the past 4 years. So yeah, RRP coming down, that's nearly at zero. There's some, quarter end stuff happening right now, but that's on its way to zero. The TGA is going through what we just described. A lot of these levers have been pulled. So we get to this point now that you're characterizing, which is that something else needs to come in. So let's understand what actually needs to come in here. So, this is where it gets, I think, a bit complicated. So I want to be clear on definitions of here is, okay, we need bank reserves to go up for liquidity to improve, to, further lever into the shadow monetary base that you described earlier in that chart of that dynamic. So what needs to come forth here? Is it actual quantitative easing where the Fed is buying bonds from the secondary market? Is it, some sort of specific localized short-term loan facility like the BTFP? Is it elevating the standing repo facility further? Is it the SLR? What needs to actually happen here from here on out?
Well, there's not much juice left in the reverse repo facility. It could come down a bit more for sure, but that's not really going to solve the problem. What we're really talking about here is a situation where the Federal Reserve's balance sheet has to grow consistently, and I used a figure of 8% per annum over the medium term. That's a steady state growth rate. And that's what they should be aiming at. So all this talk about reducing the size of the balance sheet, getting it back as a percentage of GDP, or getting it back to historic levels is completely mad in my view. I mean, what they need to do is, in a debt-driven world where we accept the fact that debt is continuing to grow, you've got to have balance sheet capacity growing alongside to get the refinancing. Otherwise, you get a financial crisis. And as I would say, every financial crisis that we've witnessed in the last 30 or 40 years has basically been a debt refinancing crisis. And then central banks are forced to come in to bail the system out. Now, what I'm suggesting is, unless something happens relatively quickly, and I'm talking about through the rest of this year, they're going to have to come back in size to bail the system out again, because you get another failure. And clearly we want to avoid that. So what the Federal Reserve should be doing is going back to a QE process as soon as they can. Now, I've been in this business long enough to know that they're not going to call it QE. They're going to disguise it and call it something else. So the acronym department of the Federal Reserve will be working overtime, burning the midnight oil to come out with something else. Could it be QS, quantitative support? I don't know. But they need to expand their balance sheet. It used to be called open market operations in the old days, but maybe we've moved on from there.
Mm-hmm. What you're saying is effectively that, there's two things I hear there. That the Fed wants to normalize their balance sheet. They want to get duration off their book and have the duration match basically like short-term bills like it used to be pre-2008. And they don't want to do QE before rates are zero. What you're saying is both of those goals are unrealistic within this highly debt-driven economy.
Yeah, I mean, this is equally madness. Why does the Federal Reserve want to do a major duration dump on the private sector? When the private sector, it's madness. This is taking liquidity out of the system. Now, cynically, and a number of people have suggested this, that the Federal Reserve is being mischievous here deliberately, and they want to somehow crash the economy because they don't see eye to eye with the administration. I mean, that would be foolhardy. I don't subscribe
Yeah.
to that, but clearly there are people who are talking those words.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Yeah, I do think that brings up a good point of, the level underneath that idea of potentially crashing the economy or whatever is this idea of this debt refinancing wave that you just mentioned here. So, if you hear the Scott Bessent side of the argument, which is that we want to get the long bond yields lower. We want to recalibrate the economy towards the private sector. But really specifically, it's this idea of trying to get long bond yields lower. And then when you think about the composition of debt as it stands right now, he's got a tough job that he just adopted from Yellen, right? She was issuing bills like crazy. So if he wants to refinance all that short-term T-bills into longer duration debt, how do you think about this needed debt refinancing? Do you think it's enough to, take a haircut of 20% on equities, get the 10-year below 4, low 3s or something like that, repivot all these bills into longer term debt, and then, head on into the distance? Like, how do you see this debt refinancing wave start to potentially happen?
I think it's really, really tricky, Felix. And I think it's like the old Irish joke is if you want to travel to Dublin, don't start from here. And that's the problem they've got. Effectively, the legacy of Yellen for Scott Bessent is a really bad one. He's got a very, very difficult situation to manage. He's a very smart guy, and I'm sure he'll come up with a solution. But the fact is, he's sort of boxed in. I mean, he can't really issue a lot of coupon debt now without disrupting the market significantly, as far as I can see. He probably doesn't want to create an economic slowdown, although in many ways, I mean, if a slowdown occurs, that could be welcome because it may ease the funding burden because it will cause yields to fall back. But you see, the problem you've got is if you start to look at this in an international context, the US is in a more tricky situation than it was a decade ago because there are not that many there are fewer, I should say, international buyers of US government debt than there were a decade ago. The Chinese have stepped back. The Japanese don't seem to have the same appetite. You're really reliant on offshore hedge funds to do a lot of that. And that really comes through in something called the basis trade that you will be well aware of. So, how can they find, foreign buying? And the problem is, if you look at the foreign markets, term premia, that sort of wonkish concept that tends to dominate the bond markets and contribute to rising yields, term premia are actually increasing. And they're increasing because deficits around the rest of the world are increasing. The Chinese say they're going to increase government bond issuance. The Germans, we know, are. And this chart, which you've just put up, is basically illustrating the backdrop in the US Treasury market. Now, if you look at that, the orange line is basically the 10-year yield. And I've put on there, what I see are the sort of the trend lines of indicating where the market's trading. I mean, you could argue that there's a different channel unfolding now, which is maybe more horizontal, but arguably that's the picture for yields. But if you look at the black line at the bottom, that's term premia on our estimates, daily term premia. That's trending higher. So what you've got in prospect is if the economy slows and the Federal Reserve is forced to cut interest rates, there's a pronounced steepening of the yield curve likely. And that's maybe something that's going to occur. And that might give Scott Bessent the facility to fund around the mid-duration area. But forget long-dated coupons as far as I can see.
Yeah, that brings up a good segue into how all this, liquidity, monetary plumbing talk starts to affect other asset classes in markets. So you've had some really interesting analysis of effectively this yield curve suppression, which I think is a really important concept as well. I would love for you to just explain that a little bit of how did you mechanically unpack the idea that, if you extrapolate the yield from mortgage-backed securities as opposed to the traditional U.S. Treasury, like the par curve or something like that. What does that mean that we've actually been suppressing the yield curve, and how does that actually reflect in the markets? You had a really interesting analysis of how that actually had a second order effect on break-even inflation rates, which makes it understated. So, I'd love for you to just unpack that idea.
Yeah, what that's saying is that if you look at the mortgage the mortgage market or MBS securities are basically government backed, and central banks, even the Federal Reserve, holds mortgage backed securities and deems it a risk free security. Now, the difference between a mortgage backed security and a US Treasury is that a mortgage backed security has longer duration, and it has, to use another wonkish term, more convexity than a normal conventional treasury. And so what you can do is mathematically, because bonds are all about maths, is you can basically bring the mortgage-backed securities back to an equivalent duration and convexity as a normal treasury. And that's what we did we did that as an exercise. And if you look at the difference between a bootstrapped 10-year treasury from the mortgage market and the actual 10-year treasury, the difference is about 100 basis points. In other words, the actual treasury is trading 100 basis points cheap to the bootstrap version. And if you do an analysis, and I haven't got charts on this here, but it's all in our research. If you do a comparison between that gap, in other words, between the bootstrap version and the actual yield, you find that it correlates extremely closely with bill issuance. So when Janet Yellen poured funding towards bills, what that caused is a big deviation in the spread between the bootstrapped and the actual 10-year yield, simply because there was a scarcity of coupons in the system, and that's what happened. Now, what are the consequences of that? The consequences are that if you if you add 100 basis points to the 10-year yield, the yield curve over the period from 2023 onwards has never inverted. Okay.
Mm-hmm.
So there was no signal of a recession. So the recession call was a false flag because the treasury yield had been distorted. Secondly, if you look at the TIPS market and you work out what break-even inflation rates are, you find that actually break-even inflation rates should be 100 basis points higher. Well, actually, lo and behold, if you graph that against the University of Michigan survey, what you find is that adjusted break-even inflation rate moves much, much more closely with the University of Michigan consumer survey than anything else, and certainly than the published break-even numbers do. So what it's saying is there is higher inflation in the system, and the economy never got anywhere near recession, despite the calls of many economists in the last 2 or 3 years. Look forward, it may be, we may be seeing another slowdown in the economy coming up, but if you want to bet on a recession, bet forwards, not backwards.
Yeah, I think this is one of the most important concepts, because when you think about it, like all discount rates are based off the 10-year. So if we're using the wrong rate, this is like huge. So I have a couple questions for you on that point, which is one, how does this dislocation solve itself, and why? Like, is my understanding is that was largely caused by this scarcity of duration coming onto the market, not QE specifically, because we've had many years of QE before, but we never saw such a dislocation. So is it mostly because of that, you know, activist treasury issuance policy that Yellen pursued?
Exactly. It's the not yield curve control dimension,
Right.
rather than the not QE. Exactly right. Yeah, that's true. How does it resolve itself? It resolves itself through term premia rising, and on most estimates, term premia are negative, or certainly have been negative. Our estimates are still negative. We have a different take than maybe some of the other models, but our numbers show still negative term premia, and that term premium, as we indicated, is rising. The other question, therefore, which comes through this, is what happens to the credit markets, and what are the implications here? And I think that's clearly something which is of import, given the fact that if you look at the triple C, the triple C bond corporate credit that ended last quarter at 13.2%. It's jumped 200 basis points pretty much since early January. And these are pretty sizable moves coming through now. So the
Yeah.
credit markets are deteriorating. This is something which is quite interesting, which is maybe a precursor to this. In the way that we understand markets, there are two dimensions. One is the flow of liquidity, and the second thing is the deployment of that liquidity into risk assets. Now, from everything I've said so far, liquidity isn't declining. It may be slowing in its momentum, which is clearly something of concern. But what is actually happening as well is the other dimension, if you like, the other blade of the scissors, is actually deteriorating faster. And that is looking at what we call the world risk cycle. This seems to be about a 9 to 10 year cycle. And it basically shows how investors deploy assets in their portfolios split between risk assets and safe assets. Now, what I've shown on that chart are two lines. The orange line is the US for US investors, and the red line is for world investors. So the US is clearly a subset of the world here. But what it shows is a very sharp deterioration through this quarter in the risk appetite of US investors in particular. And the question that I've posed is, why is that going on? Now, some people may say it's the uncertainty over tariffs. That's possibly true. Then you might say, well, okay, why isn't the world deteriorating faster? And my view is it's because of the US economy deteriorating. And I think it comes back to this slowdown in the hidden stimulus that I've been articulating. Now, if we then go on to what's happening in the credit markets, what you find is this interesting chart. And this takes me back to the time that I was at Salomon Brothers and a key indicator of one of the risks in the bond markets, and particularly a risk for the credit space. Now, what you see here is the orange line is looking at the spread between single B and triple A corporate securities. And, clearly that credit spread is an indication as it widens of tensions and potential default risks. And what I've put on top of that is the convexity in the Treasury yield curve. Now, that convexity is simply a measure of how much the 5-year bond basically trades in yield, trades above the average of the 2 and the 10. So it's basically what's called in Palmer's a butterfly spread, but it's a measure of convexity. And one of the things that I learned during my time at Salomon Brothers was to say, if you start to see spikes in convexity, it's normally a heads up to a deteriorating economy and deterioration in the credit markets. And this is what you seemingly are getting. So you've had this upward spike in convexity, and you're starting to get deterioration now coming through in terms of the credit space. The next slide is looking at another way of analyzing the credit space, which is to say, well, okay, let's go back to our old friend, the mortgage market, which is basically shown here for 30-year mortgages in black. Now, even appreciating the fact that these have higher convexity and longer duration than corporate credits. Corporate credits are probably nearer 5 to 7 years in their duration. Even making that allowance, what you're getting is credits trading through mortgages, and mortgages are government-backed securities. So this seems to be, again, remarkable. That what you've got is this has never really happened. And even if you squint back to 1979, it didn't really happen then. I mean, the two lines look close, but they never intersected. And what you're looking at now is that feature. So it looks to us that the credit markets are really priced for perfection in a world where you may not be seeing a US recession, but you're seeing nominal GDP growth slowing from about 7, what maybe at times 8%, down to perhaps sub 4. And that will be difficult for the credit markets to stomach without tensions rising. And this is why, given the credit markets' role within the global financial system and the fact that they do sustain collateral, is why the central banks need to be alert to this deterioration.
Yeah. Michael, this point that credit spreads, which are effectively a reflection of probability of default at any given time, and this is something I've actually wondered a lot, and it's a random question, but you know a ton about, you traded bonds forever in fixed income. I'm trying to figure out, why are credit spreads priced for perfection? Why are they so secularly tight? And I think a lot about back in 2020 when the Fed came in and bought commercial paper. And I think that surprised a lot of people. And I will wonder now is that ever since then, have credit markets have to price in this idea that the Fed, if things get bad enough, the Fed will buy commercial paper, and that's why credit spreads remain so tight. Have you thought about that much?
Yeah, it's a very good reason, a very good
Yeah.
rationale. I think there's mileage in that, Felix. I think the other thing is that because a lot of corporate debt was termed out, there's not that much around in terms of what people can buy. So there hasn't been a lot of new issuance, for example, relatively, and that may be another reason why you've got yields are so depressed. And certainly, if you do, I mean, the other way to look at this is, although I haven't got a chart here, but you can see it very clearly, is to chart the ISM, the Purchasing Managers Index, the PMI for the US, against credit spreads. And if you look at that relationship, it's basically 1-for-1 until the last 5 years or last 4 years. And then you see a big disconnect where the ISM has hardly moved up, but credit spreads have really come dramatically lower. And that just doesn't add up. So, something very odd is going on. And I suggest this is supply and demand factors again. And it's because there's a scarcity of issuance.
Yeah, that makes sense too. Okay, for the last part of the conversation, I want to shift gears a little bit here and talk about China and talk about gold, because the way you think about those two seems quite interwoven together. So you have some really interesting charts in here looking at what is the state of China as it stands. So, when I think about the last few months is this characterization that the dollar was very strong into the lead up of the Trump election. And that was happening at the same time that China was going through a pretty significant deflationary shock and potential outright recession. And because of that, there was a lot of expectation for them to come out guns blazing with monetary and fiscal bazookas, but it really wasn't moving the marker like many investors hoped for. Now we're at a point where the Dixies has come down a lot, and I would love for you to just update us on how are you thinking about China as it stands today within that context.
So the first thing to say is that although you may cynically say that Scott Bessent would favor a recession or a slowdown in the US, the Chinese definitely don't. They want a stronger economy. So what they're enacting now is a significant change in Chinese economic policy, monetary and fiscal. Now, the way to see this, or way to start this, is to look at what happened at the end of 2024. And the graph I've got in front of you is to show in orange the yield on the Chinese 10-year bond. And look at how that bond collapsed at the end of last year. And this was basically in the wake of Trump's election. There may have been concerns, understandably, about tariffs in China, but this was fundamentally because the Chinese central bank put its foot very, very firmly on the brake to basically hold the yuan up against what was then a very strong dollar. So the dollar surged in the wake of the election, as we know. The DXY, hit close to, probably touched 110 on the index, or got very close to it. And basically what you saw was potential weakening across other crosses, and in particular the renminbi came under a lot of pressure, which caused the Chinese authorities to really tighten hard. Now, what that did is it threw the Chinese economy into a tailspin. It suffered debt deflation again. China, as we know, has a big debt burden, and investors fled towards the safety of government debt. They went into safe assets. They shunned risk assets, and look at the scale to which that yield on the 10-year bond plunged. Okay, this is something that you don't see very often. You certainly don't see over a short space of time. This was a panic going on in China. This wasn't about interest rate expectations changing. It was about term premia falling. And I put the term premia graph underneath just to show that the bulk of that move was basically a fall in term premia, which was basically saying that investors were rushing for safety. What you've seen since then are a number of features. One is we know the dollar has softened. That has given the opportunity for the Chinese to ease. But on top of that, there have been statements coming out of the hierarchy in China. Xi Jinping has basically said, he's given a pro-capitalist speech. He's actually wheeled Jack Ma in to applaud him from the front row. And, I've been in markets long enough to recall what happened in 1992 when his predecessor, Deng Xiaoping, went on the celebrated Southern Tour to espouse the virtues of capitalism in the capitalist regions of southern China. And, he came out with a statement, to be rich is glorious. And this is probably akin to that in a way, maybe a watered down version, less explicit, but we're going in that direction. And what this is saying is that China is refueling itself. What you've seen is the bond market has recovered dramatically in yield terms. There's been a huge bounce in yields. That has been a term premium move, as the black line says, and that's now reversing out of safe assets back into risk assets, and that's where the Chinese market is flying. Now, if we take a look at this chart, this is looking at the net liquidity injections of the People's Bank. And what I've done here is to look at seasonally adjusted, a rolling 3-month total, to try and, to get through some of the noise that you inevitably get in the Chinese financial system at this time of year because of the changing Lunar New Year holiday. But what it shows is that an annualized rate, they are injecting something like, 20 trillion yuan into the system. And if you divide that by 7.25, you can see that's getting to something like $2.75 trillion of net stimulus. So these are sizable amounts of cash that the Chinese are throwing at their system. That's kind of equivalent to what happened in the US after the GFC. So we're on that page. This is really important. Take a look at Chinese real estate prices as published by the BIS. They're starting to strengthen. So all these things are important. Now, one of the things that I've tried to argue over the last few years is that what you've got to watch is not the US dollar yuan or the renminbi yuan cross rate, but to actually look at the renminbi gold price. In other words, that's the important factor. Now, what I argued is that to get out of its debt deflation, China needs to get the yuan gold price up to about 26,000 yuan per ounce. Okay, that is equivalent at current exchange rates to about 3,600 US dollars per ounce. Now, hold that thought. Why are they trying to do that? Because under a debt deflation, the only way to get out or dig out of a debt deflation is to devalue your paper money. And the reason that China is in this bind is because the debt liquidity ratio of China, think of what I was arguing right at the beginning for the advanced economies, but China's debt liquidity ratio is currently about 30%, or was 30% too high. So what they've got to do is to basically print enough liquidity, monetize, in other words, create monetary inflation to bring that ratio lower. And that ultimately devalues debt. Now, what's the best benchmark against that? It's not the US dollar yuan cross rate. It's basically devaluing paper money against a real asset. And a real asset is gold. So if the yuan gold price goes up by 30%, from where we were arguing, which was basically around late 23, early 24, if you see a 30% rise in the yuan gold price towards this 26,000 target, then you know you're some way to digging out of the debt deflation in China. And that is exactly what's going on. So while everyone's been focused on the yuan US dollar, even the People's Bank seemingly, behind the scenes, you've got this process going on. Now, therein lies an interesting debate, because you could equally fire back at me and say, well, do the Chinese really control this? Surely, we've got a dollar gold price, we've got a yuan US dollar cross, and you triangulate that back into yuan gold price. But just think of this process being reversed. Maybe it's no longer the London gold market which is driving the gold market. Maybe it's the Shanghai Gold Exchange which is doing it. And if the Shanghai Gold Exchange is setting the yuan gold price, and you hold that 7.3 or 7.25 yuan dollar cross, then you triangulate the other way into a dollar gold price of 3,600. Now, clearly there's going to be an argument both ways. Some say it's Shanghai, some say it's London. But I would say the argument's been our way for the last few months. Gold is rising. No one can seemingly understand why. The Chinese are buying lots of gold. China is a big hoarder of gold. China is the world's biggest gold producer. Doesn't this make sense for them to do this?
Michael, how do you think about all the gold that's, when you talk about this, the first thing I think about is in recent months, we've just seen an obscene amount of imports of gold into the US, so much so that it's completely blown up the Atlanta Fed GDP Now forecast where they have to gold adjust it just because of the amount of gold that's been imported into the US. Is that relevant to any of this framework, or why do you even think all that gold's been coming into the US? Is it just a tariff thing?
Well, it's difficult to know. I'm not an expert on the gold market or the gold exchanges, so it's very difficult for me to judge. But from what I understand, one of the things that's upcoming from the summer is that under new BIS rules, gold bullion is a tier one asset, and it means that the major banks can't hold derivatives as a tier one asset. They've got to start using bullion, and so there's a lot of cashing in of futures and derivatives towards bullion, on the sizes that are going through the COMEX exchange. The settlement into gold bullion are eye-wateringly large, like figures that never been seen before. And then you run into the problem that, for example, the London gold market is supposed to be T+1 settlement, and it's turned out to be T+6 weeks, which is clearly something very odd is going on there. And you come out with banal excuses from the Bank of England that they can't transport the bullion fast enough because of traffic logistics in London, which is even more absurd. But there we are.
That's
So this is the situation you've got now. The other sort of segue into what's happening is then to say, well, okay, the other interesting point, which sort of links into gold, is then to say, well, okay, what's been happening to Bitcoin, and maybe Bitcoin is a barometer of these liquidity and gold dynamics. And there is a chart a little bit later on of that fact. This, by the way, I just want to say this is an interesting heads up before I get there. This is data as of the end of February, includes February, I should say, which looks at net inflows into the US dollar. We do a lot of cross-border flow analysis, and this is what our data tells us. So contrary to what the media have been banging the table about and saying there's this huge exodus out of US assets into the rest of the world and out of the dollar, I mean, there's no evidence for that, okay, for heaven's sake. I mean, okay, there may have been some fund shifting, but this is not a major shift out of the US dollar by any means. On our definitions or our numbers, money is still going into the US. The reason the dollar is softening is not a secular phenomenon. It's a cyclical response to a very strong US economy in Q4 and now a softer economy in Q1 relative to the rest of the world. That's normally what you see. You'd see the dollar going up in Q4 and coming down in Q1. That's exactly what's happened. But anyway, that's an aside. Here is our weekly liquidity chart shown as the black line. That's global liquidity weekly. This is shown as a 6-week change. There's nothing, there's no mystification in a 6-week change. It's purely to remove the noise in the data series. And I could have chosen 4 weeks or 8 weeks, but I chose 6. And what I've shown is the equivalent 6-week change in Bitcoin shown in orange. And all I've done in the chart is to advance the global liquidity series, time series, forward by 13 weeks to show that it's approximately sort of leading by about 3 months. Now, what this is basically saying is you could well get a rally in Bitcoin over coming months. That's, one accepts that because global liquidity is picking up again. The problem that I'm trying to cite here is that I'm not looking at the next 3 months. Generally, my concerns are about the next 6 months, 12 months, 18 months. And it may be that black line starts to fall further and maybe faster over the horizon that I've got here. So there may be a trading opportunity, no question, but this is what's happening. Now, the other thing to start to think about is that there is a distribution of leads and lags with Bitcoin and global liquidity. And this chart is trying to demonstrate 2 things. These are statistical analyses. One is a Granger causality test, which is shown as black line. And that basically tells us that when that line goes towards 0, or is at 0, there is strong Granger causality between global liquidity and the Bitcoin price, effectively from 7 weeks onwards. And you can see that thing. So there's nothing, or it's ambiguous up to that point, but it seems to be clearer after that.
I just want to say this is such a great chart because, as a statistics nerd as well, people get so caught up in correlation. But what you have here is a causal factor. And I think that's really important to say, is that this is not spurious correlation. This is a Granger causality test that this is what impacts Bitcoin.
Yeah. The orange bars are basically showing the correlation coefficients at each particular weekly interval. Now, there is statistical noise in that, so you've got to sort of go slightly boss-eyed and look at the shape, but you can see there's sort of a hump-shaped curve there, which is probably peaking at around 13 weeks, which is why we get that result. So that's the feature. Now, the thing that I wanted to focus on was actually this pie chart. And what this pie chart is basically illustrating are the systematic influences on the price of Bitcoin. And this comes from using a VAR, vector autoregression regression model, to try and understand the systematic influences. And what it shows is there are three basic sets of influences on Bitcoin. One is global liquidity. The second is investor risk appetite. Now, the reason that's an important statement is that liquidity can be going up, but risk appetite can be souring at the same time. And in other words, the S&P is dropping, and consequently, Bitcoin is getting a negative impact from that fall in risk appetite. And that is something that influences Bitcoin, but it doesn't influence gold. Gold does not have that same response. The other element that you can see in that pie chart are the two lower slices, which is actually the gold price itself, which has an influence on Bitcoin, and the gold to Bitcoin ratio. Now, if you're a statistician or a mathematician, you can see that those two slices actually form what is called an error feedback process. And what that basically is saying in straightforward language is that Bitcoin and gold tend to move together over the long term, but they don't move at the same speed. Sometimes Bitcoin will go in advance of gold, so gold then catches up, and sometimes gold will move first and Bitcoin catches up. So you get this sort of race, or if you like, of two creatures running a race. One is in the lead, then the other catches up and leads, and then the other catches up. So it's a bit like a horse race, and that's what's going on. So if you look at what gold was doing in the fourth quarter, it was subdued. Bitcoin was racing ahead. Now in the last quarter, gold has really raced ahead, and Bitcoin has really has done very little. So that is a typical error feedback process. But effectively, what you could say is there are three influences on Bitcoin: gold, risk appetite, and global liquidity itself. And our view generally is you've got to look at the steady state here in terms of long-term positioning. And if you believe that debt is rising at this rate of 8% per annum, then you've got to have monetary inflation hedges in your portfolio, because for financial stability reasons, liquidity has to rise at the same rate as debt. And if liquidity rises, Bitcoin and gold are going to rise at the same pace. And if you want just simple proof of that, since year 2000, the stock of US government debt has increased by a whopping 9.6 times in total size. The price of gold has gone up by 9.65 times, just slightly more. So gold has kept pace, and it's all because of that relationship. And Bitcoin's done even better, as we know.
Fascinating. I love that analysis. I think it's very prescient and important. Okay, Michael, just to wrap us up here, it sounds like when you just parse through the outlook for liquidity short term, as you've shown that short term gauge, there might be a bounce here for a little bit, but for the most part, things get pretty hairy in the fall, and it sounds like it's just plain caution for 2025.
Yeah, there is huge uncertainty until the Federal Reserve, shows the color of its money, so to speak. We've got the debt maturity wall coming up. We've got a Federal Reserve that's seemingly sitting on its hands, or actually in practice still doing QT. And the only central bank that's really easing liquidity aggressively is China. But then look at the relative performance of the Chinese stock market versus Wall Street. That spells everything out.
Yeah, absolutely. Michael, always good to have you on. That was a really great hour. Really enjoyed it.
Great, Felix. Enjoyed it enormously. Thanks so much.
Thanks.